initially I had to like beg and borrow and steal for them to get into these investments and say, okay, you need a week, no problem, you can take your time, because I didn't have any leverage. Yeah. And now I'm begging my investors not to wire funds before they have documents, because it's very important for their protection.
Hello, everybody. This is Jake Stenziano, host of Wheelbarrow Props Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Mr. Stenziano, this is the second time I see you today. I'm doing fantastic. The more I see you, the better I am, my friend. How you doing?
Always making it happen, big man. Today's guest is Veena Jetti. Veena is a founding partner at Enzo Multifamily. She oversees $1 billion plus in assets and specializes in the company's growth and asset management. So without further ado, Veena, welcome to the show.
Hi, thanks for having me.
It is our pleasure. Let's get this thing kicked off. Tell us about the early days at Enzo and how the company started.
Oh gosh. Okay. So that's like a really long and winding story. So first correction, I have overseen $1 billion of assets. That was at my former life when I was in corporate America. So currently we're not quite that big yet, but one day soon. So Enzo started with Sapan Talati and myself. We're both the founding partners of Enzo. And really we met through one of these like virtual meetups, one of these virtual like conferences, started talking, realized we had a lot of the same goals. We had both kind of reached our ceiling, if you will, with single family investments. And so it was just time to move to that next level and scale up. We had a lot of complementary skill sets to each other. So it was kind of like a yin and yang, worked out really well. Started working together several years ago, did our first project, did some not so great projects, did some really great projects. And then we kind of have ended up here, but since then we've added two partners to Enzo, Neil Dandona and Pooja Talati, who is actually Sapan's sister. So she came highly recommended.
So what is your previous background? Did you go to college? Did you get into multifamily? What was it?
I did. I went to college, I partied for 4 years, not a whole lot of anything else. So my family has been in real estate investing for over 30 years now. And so I kind of grew up going to property tours and closings and lawyer meetings. And actually for the longest time, I thought that was something like everybody did. I didn't realize this was weird that I had been to like 10 closings by the time I was 5, 6, 7 years old. And so I grew up in a real estate family, went to college, graduated with my degree in finance in Chicago, and then went into corporate America, learned about corporate real estate through the downturn. I graduated in '07, so it was right when the market was kind of going, ooh. So my first experience in corporate America was interesting, to say the least. It was a lot more comfortable because it was corporate money and not my money, but I learned a lot from it. I remember, working out deals with banks and, just trying to keep above water at the time. Everybody was struggling. And so after that, that was in California. I left California, ended up moving to DC ultimately, where I was at Tishman Speyer. That was my last corporate gig. I had $1 billion asset under my management there. Decided that, I need to figure out a way to minimize our family's tax burden. And I could do this for myself and probably make myself a lot more money than I'm making somebody else. So that's when I left, started doing single family investing. And now here we are, multifamily. So now we do only multifamily exclusively.
So why did you start with the single family home space?
It was something my family had been very involved in. I understood it really well. I knew it really well. It felt comfortable. And it just seemed like that was the right first step. But it's funny because now looking back, if I could go back and redo all of it, I would have skipped single family 100 out of 100 times and gone straight to multifamily.
So what did your family say? Blasphemer. What are you doing, multifamily?
Actually, you know what my parents say now? They say, I wish we knew what you knew, because we would have done that too. And so my parents have actually completely divested out of single family now.
She's
and
converted
they
them.
only do multifamily. I did convert them. So they're only invested in multifamily now as well. So we're definitely, the Jetties are a multifamily family. All of my parents, my in-laws, my brother-in-law, everybody's invested in multifamily only.
Gino is a multifamily family only. 6 kids, baby. That's what it's all about.
I know.
So there's a lot of questions I have to unpack there, because the first one is what kind of pushback did you get when you told them multifamily? And then I want to hear the progression of how you convert them, because it's important for the listeners to know that you cultivate relationships and you're cultivating money from your family. There's those relationships, how you build them over, and how do you convert them over, because it's hard. And also, let me just jump on that also. You're having all that negative energy from people telling you you're crazy, you're not going to do that. Now you look back, it's converted them, but that conversion didn't happen overnight. So can you dive into that?
Yeah. So actually, for my experience, it was actually a lot easier to convert them because they had so much experience in single family. Because the big challenge I felt we faced in single family was it's not a very scalable model, and there's a lot more risk involved in it if you consider it from a property by property basis, right? So most people don't go into single family and buy, 10 homes in a week, right? And at my busiest point, I was buying 5 homes a week. So I was definitely in single family, but the scalability is still not there because there's only so many houses you can be looking at because they're not in the same location. So there's no shared services. You can't have a porter on site. I outsourced my property management, but I still was making, day-to-day management decisions, which I don't want to do. And so when I went to my family and was explaining to them how multifamily works, non-recourse lending is like a huge difference between single family and multifamily. And that in and of itself is a vote of confidence when Fannie Mae and Freddie Mac are telling you, hey, we're going to be your largest investor into this multifamily asset. And so that's, one thing I always talk to investors about when they're worried about putting, $100,000 into one of our assets and they want to go into like the nitty gritty of underwriting. I'm happy to walk them through it, but I also tell them, listen, you're not my biggest investor into this. Freddie Mac is, or Fannie Mae is. And every piece of underwriting that you do, they have done at a much more conservative level, 100 times deeper than you've done it. So that was kind of one thing. The second thing was the scalability. So the vacancy risk and the occupancy risk dramatically decreases, right? So when you have 10 single family homes and you have 1 vacancy, that's a 10% vacancy. When you have a 100 unit building and you have 1 vacancy, well, that's 1%. You actually don't want to be at 100% occupied because you're leaving money on the table there. So the risk is lower when it comes to vacancy and occupancy. Now, of course, this is asset dependent, but the assets we go into are typically solid B assets. So we typically sit in that sweet spot in the market.
Mm-hmm. So why were your parents in single family for so long when it was so easy for you to convert them? I mean, what was that conversion? You've talked about it, but for them to actually be doing it for 30 years and 2 years later, they're completely out. What was that?
Yeah. So they both retired early on their real estate portfolio. So they were, they're kind of like enjoying life now. They live down the street from me. So they've been seeing what we've been building for years and years and years. So this isn't the first time they were exposed to it. I think that had they had the opportunity when we were younger, they maybe would have taken that leap. It felt like a bigger risk to them because, we do put out pursuit costs a lot earlier and, that could end up being wasted money. I mean, we've gone after deals that we've spent $10,000 on attorney's fees and they just haven't panned out. And growing up, my parents are immigrants. They came here in 1980. So they didn't have the same safety net that I have had growing up. So they didn't, their parents couldn't just bail them out. They couldn't just move in with their parents if they lost the shirt off their back. So when I went into it with, my parents have done really well for themselves. So I had a safety net. I have a husband who's a high income earner. So I had a lot of safety nets around me that allowed me to take those leaps that my parents didn't really have when we were growing up because they were still building the family's wealth. And now, our generation is growing it. So the next generation will probably just spend it all. I don't know.
So what are some of the tips you can give listeners on how to actually get out of that corporate job and get into multifamily full time?
Yeah, it's a really tough leap because it's scary, right? Like, so I was just talking about security and safety nets. And I think that the best way to do it is to build up a passive stream of income. Obviously you want to watch your expenses and budget appropriately, but at some point the rubber has to meet the road and you just have to take that leap of faith. When you have to eat, you gotta make money. So I personally feel like when you're struggling, that's when you work the hardest, because you don't have another choice. When you have to feed your kids, what are you going to do? You are going to go out there and make it happen, right?
Mm-hmm. I totally agree with that.
She's MIH, Gino. She's making it happen, buddy.
Yep, MIH, yep.
So let's go back to the
I'm on the Facebook group.
Let's go back to that first deal. How did you find that first deal? How did you finance it? What market did you select? And, give us the idea of what happened with the first deal.
Yeah, so, well, actually, we recently entered the Florida market, which I think you guys had a chance to tour. So,
yes.
And that one's kind of fresh in my mind because I was just looking at the numbers. So I'll kind of talk about what it was like entering a new market, if that works. So Palm Trace was the asset you guys had toured, and I saw the picture of everyone around the pool. And so that was our first asset in Jacksonville specifically. And that was a market that we had been studying for like 2.5 years actually before we actually entered into it. Most of our assets up until then have been in the DFW market. Now this year, kind of going forward, and all of last year, we really focused on Orlando, Tampa, and Jacksonville. We liked Jacksonville a lot because I feel like it's kind of an overlooked market that a lot of people don't really pay attention to it. But it has a lot of runway, similar to what we were seeing in Dallas 3 years ago. It is one of those kind of diamond in the rough cities where there was so much opportunity and not as much competition. Now we're seeing a lot of syndicators, especially from the Dallas area, coming into that market. But we got that deal. So we had been building relationships with brokers over the last 2.5 years. And I mean, I'm sure it was frustrating for them because we would like look at deal after deal after deal and say no and no and no and no. And it was because people were overpaying for assets. They still are. And so what we ended up doing is we ended up getting that asset. We were not the highest bidder on that. I want to say we were the third highest on it. But we ended up getting awarded the deal because of how we submitted our offer, like kind of our package in totality. And then that seller owns several assets in the Jacksonville area. And so now we're seeing all of those come to us off market. So sometimes when you're entering a new market, you have to close one deal just to kind of plant your flag, so to speak, and then you'll start seeing a lot more deals off market. Jacksonville is one of those like interesting markets where there's about 10 or 15 groups there, and we all just trade assets between each other time and time and time again. So a lot of the assets that the seller on Palm Trace, actually that was the second time he had owned that asset. And I'm pretty sure at some point in the future, he'll buy it back again as part of a portfolio and then trade it out again. So that's how the Jacksonville market kind of works.
So let me ask you, what's the reasoning behind that? What do you think they keep buying and selling their assets? They're just moving money around, or?
Moving money around, the assets are appreciating, the market is growing. They'll pick it up as part of a portfolio and then cherry pick out the ones that their money actually wants to keep or capitalize. A lot of the groups in Jacksonville specifically work with a lot of these equity groups, equity partners that are institutional money. So they're not necessarily syndicating assets. They're bringing in large equity partners who have very aggressive terms that they need to see. So instead of buying, one asset at a time, they'll go in and buy 11 in a portfolio, but really their target was 7 of them. So then they'll cleave off the 4 that don't fit that model.
Gotcha. So when you're looking at a specific deal like the Palm Trace, what are your criteria for underwriting the deal? What are you looking for in the deal?
Yeah, so it kind of depends is really the answer. And, as the market has started shifting, we've kind of started shifting our underwriting and our investor expectations. There was a time where 20% IRR was not an issue. That's not the case today. So when we look for our investors typically look for a stabilized asset, a solid B or, you know, a C asset in a B location that can be repositioned. They look for protection of principal. They look for a tax advantage investment, which, you know, we all know cost segregation, bonus depreciation is really giving them that negative K1 that they can take advantage of. But so from the Enzo side, our typical box, if you will, is we have a 100-unit minimum. And I say that because I don't really like to do 100-unit deals. It's a lot of work to do smaller deals. I prefer the 200 and up units. But like I said, sometimes you just come across a deal that you can't turn away from because it's a really great deal. So I think you visited one of our other assets that was 100 units. We actually bought the unit next door, and that was a 28-unit deal. And it was the hardest deal I've ever done because it was the smallest deal I've ever done. But that was the same seller, and it was literally next door to an asset we already had 100 units in. So it made a lot of sense in that situation. We look for 80s vintage and newer. Sometimes we'll go into a 70s vintage asset, depending on the story there. We look for mismanagement. We look for opportunities to raise rent or more efficiently manage the asset. I mean, I think pretty much standard for what most syndicators are looking for at this time. Our returns that we're seeing, you know, we like to underpromise and overdeliver. So, you know, we're looking for anything 14, 15, 16% IRR is kind of what we're seeing these days very comfortably. All of our assets currently are overperforming on pro forma expectations. So time will kind of tell where those end up.
So can you explain to the listeners why it's harder to do a small deal than a large deal? Yeah,
because, okay, so I'll give you an example on this 28-unit deal that we closed. So it was the same owner as the 100-unit we had closed 3 weeks earlier. So we got a really great price on it because he already knew us. He was comfortable with us. We had the PSA negotiated, so we didn't have to spend a whole lot of money renegotiating a PSA. You know, attorney's fees eat up a solid portion of the pursuit cost. And so on that deal, there were 2 vacant units. And from the time we put it under contract to the time that we were ready to get clear to close we did a CMBS product on that. So by the time we were ready for the clear to close, there was 1 notice to vacate, and that occupancy dropped the occupancy of the asset below 90%, which is, you know, lenders want to see the 90-90 rule, right? Like, so 90% occupancy for the past 90 days. So this was 2 days before closing. We found out that this happened, and the updated rent roll is showing 89.8% occupancy.
Mm-hmm.
So all of a sudden we're like, whoa, we have a big problem here. We need to get this rented by Friday. So luckily we own the asset next door. It's at a slightly higher price point. So we went to our asset manager or property manager there and said, hey, give us a list of everybody that couldn't qualify or didn't want to pay this price point at our property here. Let's call them. Let's see if they'll come into an almost identical unit next door for $100 cheaper, because at the time that was what the delta was. So that's why I wouldn't have bought this property if we didn't have the one next door. I'm glad we had the one next door because we were able to get a tenant in that same day. We got leased and we got them moved in the same day. So it luckily didn't affect closing, but it could have. And, you know, the seller was on a 1031 timeline, and it was just, you know, it's the same amount of work, and there's just much more vacancy risk. There's much more risk of the lender saying, hang on a second, you have to do all these repairs, and now your deferred maintenance goes up as a percentage of the project. Your expense ratio is going to be higher. You can't justify the cost of a full-time porter on site, which can make it a lot more expensive or a lot more difficult to manage. You know, and so having the 2 assets, now it's 128 units that we're really sharing expenses across. So it's actually been cheaper for both properties now.
That's awesome. How do you set investors' expectations? Because we've done a couple syndications, and we started out with a certain preferred rate of return, and it seems if you're down or your hold period is longer. How do you set those expectations, and how do you pivot as the market's pivoting?
Yeah, it's tough. So we actually educate in between projects. So we don't wait for us to have like a project in hand and then say, hey, look, here's what you can expect on this asset. What we do is we educate in between, our newsletter, we include updates of what the market's doing, where we expect it to be. And we really make sure we understand our assets and why our numbers are where they are, right? So if we were showing a 16% IRR on the last asset, and now we're showing a 15% IRR, why is there that delta? Well, it's a risk-adjusted return, right? So maybe we're going in with more equity on this next deal. And so that's why there's more equity, there's a lower leverage on it, which is inherently less risk. So your return is very solid. If I adjust everything to be equal, this asset would be equal to or higher than the last asset. So I think it's about understanding and explaining why certain things are changed from project to project, right? Like you're never going to have two assets, even in the same market, that are identical to each other. It's not possible. So, maybe there's more workforce housing, or maybe there's a higher historical vacancy rate, or maybe there's a great school district that everybody wants to be in at this asset. So there's just so many variables. It's hard to get right on the same number every single time. And, we get to ask that question a lot with regards to our pref payments. So our pref is anywhere from 6 to 7 to 8%. We have some that can actually hit 9%. It depends. If it's off market, you can probably get a higher price because you're not paying as much for the asset because you're getting it at a lower price point theoretically. Or, maybe you're putting together an offer where you really understand the intangibles that are not as price sensitive for the seller, and so you're getting a better pricing on it. So I think you just have to educate your investors in between deals so that it's not a shock to them when we see, okay, we had 20% IRRs 3 years ago, 4 years ago, and now you're seeing like 15, 16, maybe 17% IRRs.
Mm-hmm. Big difference.
Yeah.
You have a couple tips on raising capital. When you first started out, what were the big aha moments of, wow, this worked and this didn't work?
Oh, gosh. Okay. So the first time I ever raised capital, I'm going to tell you, I did not sleep for like 6 weeks straight. I would be like going to bed at night, like just bawling. And I was like, what did I what did I do to my family? I've ruined this. I was trying to raise $1.2 million. I thought we would never get there. And, I remember turning to my husband at one point and saying, honey, we have to sell everything we own. Like, I have to sell your Porsche. I have to sell all of our 401ks. And we have to take all the penalties. He's like, what are you talking about? And it's like, we are $500,000 short. And for us, like, delivery is an absolute non-starter. So if we say we're going to do something, we always follow through, and we find a way to follow through with it. I had to go to every single person I knew, like people like my distant uncles that I haven't talked to in 3-4 years, asking them for $100,000 check. And so the first raise is always the hardest raise. I think it gets exponentially easier. Now we're at a point where, we raised $6 million on a deal in, May now. So this was back in like February. We were raising 6.1 on a deal. And I sent out an email on a Saturday, and by Wednesday I had about $10 million in commitments. And I was shocked by that. I did not think we were going to raise that quickly. And I was trying to get investors in, and I was begging investors to cut their investment in half so I could get double the amount of investors in. And it was just, it was a good problem to have, but the first one's always the hardest, and you will probably feel like you will never, ever make it, but you just have to keep grinding because you will. The second one is much easier, and it keeps getting easier every single time after that. We now have processes that we've implemented that have made it much easier. We've set expectations with investors. Initially I couldn't tell them like, hey, you have to wire in 3 days, otherwise you don't get into this investment. Initially I had to like beg and borrow and steal for them to get into these investments and say, okay, you need a week, no problem, you can take your time, because I didn't have any leverage. Yeah. And now I'm begging my investors not to wire funds before they have documents, because it's very important for their protection. but now they have, 3 business days to wire funds to us. Otherwise, we move to the next investor on the waiting list.
It's funny. I was going to ask you what the difference was between corporate money and your own money. It's either sleeping or not sleeping, right? There's a huge difference between
that is the
someone else's money and your money. But
Absolutely.
what were some of the tips? Like, what did you do right on that first one? And what have you done since then to actually raise money? Did you go to meetups? Did you send out emails? What were some of the things that you did to raise that money?
Yeah, so I think one of the keys to kind of being successful at raising capital is actually to be raising capital in between deals. So we're always raising capital in between deals. We're always building out the database. But more importantly, in between deals is a really good time to get your investors educated about what multifamily is, why we like it, why they should like it, and see if it's really a good fit for them. I have investors, or potential investors, I should say, that approach me all the time who this is just not a good fit for their portfolio. It's not a good fit for where they are or what they're looking to do. And so we actually will reject investors. We don't take every investor that approaches us. And that's more out of like a moral obligation, because every investor in our deal, I treat them as if it was my dad investing into the deal. And I think that when people feel that from the sponsor of the deal, they feel a lot more comfortable. But, all of our investors have access to the partners. They all, they email us, we communicate a lot. I think that is one of the things that has kind of set us apart. And that was one of the things that actually gave us a lot of success initially. So communication and knowing the deal inside out and backward and forward. And when you're not sleeping for 6 weeks, you have plenty of time to learn more and more about your deal. So, so I think you just, you have to know it better than anybody in any room. And honestly, once you start doing it, it just gets easier because you get more comfortable. The first 2-3 times you're pitching a deal is always the hardest.
I like that. Before we get to the short answers, what do you see your company doing? Where do you guys want to go?
Mm-hmm. Yeah, so I think you'll get a different answer depending on which partner you ask. So for me personally, there's that quote that's like, entrepreneurs will work 100 hours a week to avoid working 40 hours a week for somebody else. That is me. So right now, we're in heavy acquisition mode. We're increasing cash positions right now so that we can get into more assets, especially as the market kind of starts to downturn, and we can kind of take advantage of maybe some of the lower priced assets or over leveraged assets that need a quick exit. So for the near future, we're still going to be acquiring. We're probably going to be starting to exit a couple of the assets that are in our current portfolio. But I think we're going to kind of just rinse and repeat on the same model for a little while because it's working really well. All of our partners kind of have a cadence of what they do, what they like to do. We've started expanding quite a bit internally. We've just hired an intern on who's kind of taking on, and I know you guys are really great at hiring interns. So, we're trying to expand kind of the team a little bit more so that we have a little bit more of a process implemented. And we're very process oriented this year, tech oriented, implementing a lot of new technology across the company. Investor portals and such. So
that's a leap of faith.
That'll be the immediate focus.
It's a difficult thing to leap of faith because you've got to pay the money before you make the money, and then you're going to be making money long term. And it's just a hard thing for entrepreneurs to do because you don't. It's like buying a 50-unit complex. You've never done it before. How do you buy an apartment complex until you buy one? Right? It's a hard thing. It's the same thing with scaling up your company, right?
Yep.
I agree.
Yep. No, that's exactly it. But you got to do it if you want to grow.
Mm-hmm.
The G-Dad, pay the money before you make the money. I love it.
Dude, it's so hard, isn't it?
You got to spend money to make money.
It's so hard.
All right, gang, let's take a quick time out to hear from our sponsor. Gino, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. I know that you've been hard at work helping Jake and Gino students do just that using our framework. Can you explain to the listeners how they can get our help?
Guys, we've been hard at work growing our community of like-minded investors, and the results of our members has been nothing short of incredible. We're looking to grow this amazing group. What we're looking for is those who want to follow our proprietary framework that we've created. Buy right, manage right, and finance right. Leverage our connections, education, and mentorship as ways to take your business to the next level.
So if you're interested in finding out more about how you can become a part of our amazing community, apply to work with us at jakeandgino.com/apply. All right, and we're back. We're going to talk about habits now. So you've been in the game for a while and you've been very successful. What about a best personal habit for success? Something that you may do on a daily or weekly basis?
Oh gosh. I'm like the worst person to ask about this because I have the worst
I ask
habits.
everybody, so we want a big mix. It doesn't. Everyone's not the same. We keep it real.
Oh my gosh. Well, okay. So I have the worst habits and I try to break them. So I think the good habits that our team specifically has is we do a twice a week team huddle, where we spend 30 minutes and we don't answer any calls, don't answer any emails, but the team gets together and we all kind of go over what we're working on, so that we can interface with each other and make sure we're all on the same page, especially mid-acquisition. And then the other thing that there's a new habit we've started, which I actually am really liking. So we have recently implemented Enzo Fridays, where I turn on my vacation responder on Friday mornings saying, I'm going to be out of the office from noon until Monday morning. And then we ignore it and we just keep working. But we're trying to be out of the office from noon to 5 and take kind of the Friday afternoon to spend more time with the family and, get like our personal errands done and stuff. So, but sometimes we actually do step out of the office for a couple hours on Friday afternoons, but that's something that's new. And it's actually added a lot of work-life balance, even just turning it on, because it sets the expectation of response from all of the people that send us communication. And so now, like our attorneys and our property managers and our investors and our bankers and everybody kind of knows about Enzo Fridays. So now they'll try to call us either before noon or they'll send us an email saying, hey, this isn't urgent, call me on Monday. And so it's actually nice because it just sets that expectation, but it gives us work-life balance.
So 11:45, it's on. Everyone's trying to get the last.
Yeah, basically my calls start pinging. But of course, if we're like mid-deal and then, the seller's broker will call us or the attorney will call us and like, I'm so sorry I'm calling you on Enzo Friday. I'm like, I've been in front of my computer since 6 a.m. So.
What about a tip for scaling up?
Yeah, I think that the team is the most important thing to actually scaling up in a comfortable and effective and efficient way. I always say I find partners that are like much smarter than me, and then I partner with them and I just like ride their coattails to success. So I think if you find partners that are smarter than you, it's the best possible situation for you. Like my partner, Pun, you guys know him. He's financially the most savvy underwriter I've ever met. The way he looks at deals, it's unlike anybody else. And, him and I will brainstorm and we'll kind of spar sometimes when we disagree. And it's actually really nice because it forces either of us to strengthen our position or argument for why we should or shouldn't do something, or it forces the other one to move to the other side because eventually we have to come to a resolution. My partner, Neil, is awesome at asset management. He helps a ton with investor relations. And so his strength is something I hate operating. That is not something I like doing. I've done it in my corporate past. I try not to do it now, but he has just been like a rock star operating our assets. And you guys have seen our assets in action, and that's all Neil and the property management team. He talks to them daily. So he's very good at that. And then my partner Pooja is our brand and strategy guru, if you will. And so she makes everything look pretty and she makes it look like, there was all this thought that went into it. It all makes sense. When, before she was there, I was just like typing out an email real quick, but now, she's implementing processes and she makes us all be organized. So I think that the key to scaling up is to find those key partners for you, even if it's not a partnership like Enzo or Jake Gino or any of the other partnerships that we see out there, even if it's a JV partnership where you're partnering with another company, finding those partners that share the integrity with you, I think is important.
What is the best way for listeners to get a hold of you?
You can visit our website, enzomultifamily.com. Pretty easy. I'm also like all over social media. I'm in the Wheelbarrow Profits Academy group, so you can see me in there. I'm sure, I have an opinion.
That's a closed group, though. There might be folks listening that they can't get in the door right now, so they may have to go through the Jaybird. We'll see what happens.
So, well, I'm on Facebook. I'm on Twitter and Instagram, but I don't really use them, so don't try to find me there. Find me on our website. If you submit the form there, one of the partners will actually reach out and talk to everybody that submits the form there.
So G-Dad, we're coming up at the top of the hour. What else you got?
Money
raising tips. Get out there, kick outdoors, my
There's
friend.
a lot of stuff. She went from the Dallas area, spent 2.5 years before she found a deal in Jacksonville. Most people would have quit after a year, right? So I think patience, persistence, I think knowing what you want is really important. Finding great partners is really, really important. Action is really important. Just because you're in the business and doing something doesn't mean that's the right way to do it. Because same thing. I was in the restaurant business. I thought, having one restaurant is the right thing to do. Being in real estate and being in residential, you think is the right thing to do. Sometimes a paradigm shift, just looking a little bit outside the box and not thinking that you're an expert and actually learning is really important. I think the expectation you set with the investor is also really important. I think real estate, debt, taxes, and it's marketing for deals and marketing for dollars. And I think everyone forgets about that. That's the most important thing. If you don't have capital for a deal, you need to constantly be in front of people, because if you find a deal today, you can't show somebody else that deal unless you're accredited. But if you're doing a 506B, you need to have that relationship before you find the deal. So it's important to get out there and just talk to people, network with people. It's really important. So Jake, I could go on and on and on because there's so many gold nuggets in here, right? I mean, because everyone thinks multifamily. And I think another important thing that all of our guests who are in the business saying, it's broker relationships, getting to know the owner, creating a substantive relationship with that owner. So when he does have other assets, you pick him up and it's going to come back to you. What say you, Mr. Stenziano? Because I know we've been through that a couple of times, correct?
Hey, we love brokers and we're open for business at the end of the day. So
yes.
Gang, I appreciate it.
Good broker can like make or break a deal.
Totally.
I mean, they are really the ones that will advocate and kind of make sure it's a smooth transition process. And we're lucky to have worked with the brokers we've worked with because they've all been awesome to work with.
That's awesome.
Very cool. Well, Veena, thank you so much for today. Really appreciate you hopping on.
Thanks, Veena.
Thank you so much for having me. I've had so much fun.
See you guys.
Bye, guys.